Good afternoon, ladies and gentlemen, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. So today, FMC, about an hour's worth of prep. I've kind of packed it for the last FMC before we go into Christmas. And let's get into it. So first of all, what is the rate decision? Well, the FMC, they meet roughly every 6 weeks over a 2-day period, and that's where they set policy and federal funds target, the federal funds target range. And it's also the rate that banks charge each other to borrow or lend excess reserves overnight. Then why is it important? Well, of course, it can cause a lot of volatility, not only in the markets, but also has a wider effect on the economy. And it also may influence other central banks to follow in their rate path or in their monetary policy or similar monetary policy decisions, whether it would be to tighten monetary policy or loosen it. That's not always the case, though. We have seen during the COVID period, or during the COVID pandemic, where you might have had the Reserve Bank of New Zealand kicking off things with their rate hikes, and then the central bank following soon after with their rate decisions, or a little while later. But usually the US has an effect on, the FMC has an effect on what other central banks will do and how they play the tightening or loosening game, or whether they keep rates unchanged themselves as well. So how does it affect the markets? For the currency, if rates are raised higher than what is expected, let's say today is, of course, the rate is expected to remain unchanged, and then there is a surprise rate hike, let's say, or if there is a bigger than expected rate hike, then the currency usually sees an appreciation, because the central bank has taken the decision to tighter monetary policy more than what the markets were expecting. Again, it's about what the expectation is that the markets have of the central bank, and then what the central bank does. And if it deviates from what the markets were expecting, either they raise rates or lower rates, or they present themselves in a more hawkish or dovish way, it will have a more volatile effect on the market. So not only would a higher rate definitely boost the dollar, but if it's also paired with a very hawkish statement, or if you just have a very hawkish statement and the rates remain unchanged, that will then lead to a bullish reaction for the dollar in general. Again, it's what the markets are expecting. It's what the markets are expecting the Fed to do versus what the Fed actually does, which is where all the meat and the volatility comes from. For the stock market, if you do get a more hawkish sentiment that's provided from the central bank itself, or let's say more dovish, again, similar effect to the amount of volatility you could get. With the stock market, if they do provide a more hawkish than expected statement, you would see potentially a more bearish reaction from the stock market. And on the flip side, a more dovish statement from the central bank would provide a more bullish reaction from the stock market. The simple reason being, if the Federal Reserve has decided that they're completely done with interest rate hikes and that they're starting the discussion, let's say, on rate cuts, or what rate cuts could look like and how they could be done, that would be very dovish, and that would provide a lot of pump for the stock market as well. Yeah, no, she did have a speech. So this is just talking about what could happen, the different scenarios, Jeff. But yes, that's very important to note. So with the stock market, as said, if you do have a more hawkish than expected, let's say FMC with a rate decision, then you would get a more bearish reaction, because that means the Federal Reserve still has more work to do, and they're not confident that the inflation target would be reached at their time that they would want it to be, or they would expect it to take longer, basically, to reach the 2% inflation goal. For the bond market, bond yields usually sees a rise if rates are raised or if there's a more hawkish statement that is provided from the central bank, because that's the anticipation that rates will stay higher. Rates will stay higher for longer, or will stay at current restrictive levels for longer than what markets were expecting, and in turn the bond prices see a depreciation. Now, on the flip side of that is if they do provide a more dovish than expected statement from the Federal Reserve, then you'd have the inverse relationship, or the inverse reaction, where bond yields would start to would move down, see a more bearish reaction, and bond prices would see a more bullish reaction. Okay, where is the economy at the moment then? So let's look at the indicators that are weighing on what the central bank is also looking at, and what could impact their decision making for this FOMC meeting. So GDP quarter on quarter for third quarter, the second estimate was at 5.2% compared to Q2 of 2.1%. Inflation was at 3.1% compared to 3.2%. If we remember the inflation print that we had yesterday. All in all, nearly everything was as expected, except the CPI month on month, which ticked up by 0.1%, which was 0.1% higher than expectations. Core inflation remained unchanged at 4%. PCE price index year on year at 3%. Usually the PCE is the Federal Reserve's preferred measure of inflation, because that measures inflation on a nation as a whole rather than just the urban areas, and also places less of a weighting on gasoline prices. So it's at 3% compared to 3.4%. The core data was at 3.5% compared to 3.7%. Consumer spending at 0.2% compared to 0.7%. Non-farm payrolls was 199k compared to 150k. ISM manufacturing PMI was unchanged at 46.7. Services at 52.7, higher than the prior 51.8. UMIC, the sentiment was at 69.4 compared to 61.3. And the inflation expectations was also quite interesting, because that provided a boost to the stock market. It was at 3.1% compared to 4.5%. 5-year inflation expectations fell to 2.8% compared to 3.2%. And employment costs of 1.1% compared to the prior of 1%. The previous FOMC summary then of what had occurred from the statement. So the Fed, again, holding their interest rates steady for the second time in a row, amid a backdrop of a growing economy and labor market inflation. That is still well above the central bank's target. So the decision also included an upgrade to the committee's general assessment of the economy as well. Now, post the meeting, in the statement, it had indicated that economic activity expanded at a strong pace in the third quarter compared with the September statement that said the economy had expanded at a solid pace. Okay, so these are the little differences that we've kind of got to recognize with the wording, which is why it makes it so difficult to understand the difference between one statement and another. Is it more hawkish or dovish? Sometimes by the time you've kind of gone through and weeded through the statement or the key highlights, the market reaction has already happened. So that's one, unless there are some glaring things that are out there in the statement itself, which usually there aren't always that much, because the statement is more or less a page in length, or even less than a page. So you don't really get a lot out of the statement itself. But that little language again, so they said economic activity expanded at a strong pace in the third quarter compared to September's statement that said the economy had expanded at a solid pace. The statement also noted that employment gains have moderated since earlier in the year, but remain strong. And then Fed's Powell said that the process of getting sustainably down to 2% inflation has a long way to go, and the FOMC is not considering or even discussing rate reductions at this time. So that's well, it's called like that would be like the golden goose, really. So if Powell said the last time around that they're not even thinking about rate reductions, and most of the Fed members have stated that they're not thinking about rate reductions. If they do, then in the summary of economic projections, revert back to their June projections that they had, where they expected the federal funds rate to be at 4.6%, compared to the last one where we had seen it at 5.1%. Then in 2024, then that would be very dovish on the side of what the Federal Reserve expects for their rates. But such a big shift, chopping backwards and forwards between the summary of economic projections within 6 months or so, could be seen. Is more. It could be. That would be a very big surprise if that does happen. From what we've seen with how the Fed have done it so far. Usually they've been very incremental in where they see the federal funds target, and any chopping backwards or forwards would mean that there's a bit of confusion at the Federal Reserve, or maybe not confusion, or maybe there's a very big repricing of what the Federal Reserve thinks where the economy is headed and what they need to do to maintain a strong labor market and keeping inflation getting inflation to the 2% goal. Then the Fed minutes on November 21st, they said that participants noted that further policy tightening would be appropriate if information showed progress to the inflation goal was insufficient. Participants noted that there had been only limited progress in bringing down core services, excluding housing inflation. From the Fed Watch, this is post the minutes. Fed rate expectations little changed. The first cut seen likely in May 2024 and fully priced in for June 2024. So this is where the Fed pricing gets a bit choppy and dicier, and there becomes the ever-growing expectation that the Federal Reserve is going to cut rates in the first half of 2024 rather than in the second half of 2024. And we'll go through some of the pricing a bit later. But if you've liked the video so far, then don't forget to give us a like, share the video, subscribe to the channel, get the word out there, get your fellow traders and friends to watch it if you believe and think that this information is useful. It is. Well, of course I'm going to say that. But yeah, if you find if you find the information useful and good to use, then don't forget to do that. Okay. Right. So Fed members then, what have they said in the past? There's quite a bit that they have said. So Powell, December 1st, said that it's premature to say monetary policy is restrictive enough. Fed's Goolsbee says if inflation is not on the path to 2%, and even if the unemployment rate is going up, that they wouldn't stop tightening. Williams says that the Fed is at or near peak for the interest rate target, and also said that if inflation pressures persist, the Fed could hike again. He had comments from Fed Staley saying that she's not thinking about rate cuts at all right now, and it's still too early to know if the Fed is done raising rates. Fed's Barkin said that he's not willing to take another rate hike off the table. And then you had Fed's Waller, when Fed's Waller's comments did have an effect on the markets here. He said that if inflation consistently declines, there is no reason to insist that rates remain really high. Off of the back of that comment that Waller said on the 28th of November, the DXY had weakened, or the dollar index, and the S&P 500 had strengthened. So there was more of a note that the central bank isn't, from that reaction, you take it as the central bank, traders are thinking that the central bank is not going to hike again this year, or they're not going to restrict monetary policy any further. So that's why the markets had reacted to the data, or to the comment from what Fed's Waller had said back then. And then Fed's Bowman said that they favor hiking rates if inflation progress stalls. So I know, although we had the inflation data yesterday, that was a bit sticky. That was a bit sticky. That didn't really see inflation compared to what the markets were expecting to go down more than what the estimates were. It doesn't mean. Could that mean then that that could have an influence on what the Federal Reserve does at the next meeting? Do they decide to maybe say, again, put off the idea of the discussion of rate cuts even more so? And do they say that they still need to keep rates up where they are for longer than what they had anticipated previously? And we'll get those estimations from the summary of economic projections. It's of course, it's no surprise if when we have had inflation prints that have been higher than what the markets have expected, that the Federal Reserve have but have the Federal Reserve have taken bigger rate decisions in the past than what they had previously had been estimated to do, and a lot of that usually starts to get priced in anyway before the rate decision occurs. Okay, so looking at this CME Fed Watch on December 12th, so looking at the meeting then for the March meeting, what are the probabilities? So December 12th is basically, for this meeting, it's virtually everyone's looking for no change, so I didn't bother having a look at that. But for the March meeting, it's a bit dicier in regards to, it's a bit more uneven with the expectation. Usually when you get something like this, that's where a lot of volatility creeps in, depending on which way the central bank will decide to go with their rate decision. So you can see here on yesterday it was about 51.5% to keep rates where they are, and then about 45.5% for a 25 basis point cut to the next range of the 5% to 5.25% range. And if you're looking at the May meeting, again is looking at, you can see there that there is the odds of a potential cutting the rate by 25 basis points at that meeting, which is at 49%. But then you also have these other two, so you can see on the left-hand side with the 29.8% looking for another rate hike. So one in March and then another one in May. So you can see that we'll kind of get more of clarification as to what the Federal Reserve could do in the future, and what the Fed Watch tool is going to provide us with the information and the expectations is, would it cement the expectation for the Federal Reserve to cut rates in either March or May? But again, the next meeting, if I remember correctly, would be at the end of January next year, or maybe around then. I'll have a little double check. But even then, that expectation could change depending on what the Federal Reserve says today, giving us a bit of a direction as to what to expect for the year ahead with their monetary policy. Okay, so investment bank views then. What we had, it's on the 22nd of Josh said yes, it's about 45 days away. Okay, cool. Nice. So investment bank views, you had comments from Barclays that they said that they no longer expect the Fed to hike interest rates in January 2024. This is on the 22nd of November, by the way. They said the rates are to be unchanged until December 2024. Rabobank have also said that the Fed is going to remain on hold until the middle of next year, and the Rabobank don't believe that recent data is likely to spur the Fed into action. Since the FOMC believes that a soft landing is in sight, it would be foolish to risk it by hiking further than necessary. And if we were to see stronger economic and inflation data before the December meeting, longer-term rates are likely to rebound and substitute for a rate hike, and therefore we would not expect further hikes. ANZ in their forecast, they said that they're forecasting the dot plot cuts at the FMC meeting this week, and they expect them to lower the 2023 and 2024 dot plot. They also say that Powell will need to maintain hawkish guidance during the transition to lower growth and inflation, so is likely to stress patience. So basically, as said earlier, the summary of economic projections could provide a lower dot plot for the federal funds target range for the federal funds target rate, but Powell would still hold the view that the central bank needs to be restrictive in their monetary policy, and that they're not thinking about rate cuts at this time. That is too early. If he says, or if he doesn't, it's also what the Federal Reserve doesn't say. If he says that we're not thinking about rate cuts, and he doesn't say that it's too early, potentially that could lead to a bullish reaction from the stock market. Because remember, it's those changes in language that you have to be aware of, and whether or not, if it's mentioned in the statement or summary of economic projections, whether they go from saying they're not thinking about rate cuts and that it's too early to they're not thinking about rate cuts yet, as a potential scenario for a bullish reaction, or potentially a bullish reaction from the stock market. That's besides the point of where they see the federal funds target range, and that's where it becomes, a bit more difficult to kind of underpin what the Federal Reserve's message is. Has it become more hawkish, or has it become more dovish? And that's what I'm trying to help you guys with today. But yeah, so just one thing to be aware of what could be said or not said from the Federal Reserve. And then the Financial Times, they had a poll that said that leading economists are expecting the Federal Reserve to maintain the 22-year high in US interest rates until at least July 2024, according to the latest poll by the FT. So July 2024 seems miles away. Okay, about six or 7 months or so away from that rate decision when it does come about. So there may be a bit of a disparity in what the Fed poll and what the FT poll has said. If on one side you're expecting the Federal Reserve to cut rates in the first half, which is what some investment banks feel that might be a bit too optimistic. And then the other side, you have the investment banks that are looking at a second half rate cut to begin that cycle, that the other side may believe are being too pessimistic about what the Federal Reserve might do. So there's that little battle too. Would it be in the first half or the second half? Okay, and then market pricing. So we had on November 3rd, Fed swaps show more than 100 basis points of easing price for 2024, and they priced a first rate cut by the June meeting versus the July prior. November 14th, Fed swaps price in 50 basis points of rate cuts for the July policy meeting. Okay. And also recently as well with the expectation. So as I said, when we did have the non-farm payrolls data, the non-farm payrolls data did lead to markets expecting or changing the expectation of the first rate cut from March back to May. So there's also that expectation too. So again, the timing of these rate cuts are going to be, or the potential rate cuts are going to be quite key to how the markets are going to try to speculate on when those could happen. So with these FOMC economic projections that we're expecting to have today, that's going to be quite key. So before I show the video, let's have a look at the last summary of economic projections that the Federal Reserve had put out. Okay, let's bring that here for you. All right. So here was the last summary of economic projections. As said, they expected the federal funds rate to be at in the range of 5.6%, around that area, and then 2024 to 5.1%, 2025 3.9%. So one thing to bear in mind is with the expectation of the with one of the things that could be expected if the central bank is going to become more dovish, is going to be seen here in these in the federal funds rate figures. Okay, do they lower their expectation for 2024 by going back to what going back to the June economic projections, or do they kind of go, let's say, instead of 5.1 for 2024, they expect the federal funds rate to be at 4.9 by the end of 2024. So I think if the markets are already expecting, most of the markets are expecting the first rate cut to happen in May or March, then if there was a small shift to the median here in the economic projections, it might not do too much if that's what the markets are expecting. It might not provide that much of a bullish reaction to the stock market. But anything reverting back to the June summary of economic projections for 2024 to 4.6, okay, could then provide potentially a further boost to the stock market and a decline for the dollar index. Okay, let's see what else we got here. Okay, so that's the summary of economic projections there. GDP data is something that people sometimes put off too, which they shouldn't do in the statements, because if they expect the economy to continue to if they expect it to be stronger than what they had expected it to be, that could also provide a hawkish tone to the statement and the SEP, which could then moderate how strong the bullish market reaction could be if the Fed members have lowered their federal funds target range for 2024 and the years beyond. So that's also another thing that we have to be aware of, is the GDP data. Although the current discussion at the moment hasn't really taken over completely compared to the inflation discussion, that will soon, of course, then become the case when the Federal Reserve has to decide how well is the economy doing and how strong is the jobs market, enough for us to say, okay, if we do see a weakening jobs market and do see GDP declining more than we would have wanted it to, then maybe we need to step in sooner rather than later to cut rates to then provide a boost to the economy instead. So yeah, so if they do provide, let's say, stronger than expected GDP figures or expectations than what we had last time around, that might moderate a reaction in some way, maybe not a lot, unless we get the inverse where they expect GDP to be lower in 2024 and 25. Then that could then help. That could then provide another boost to the stock markets instead, potentially. All right, so that's the summary of economic projections. Let's go to the video then for the last rate decision that we had. Okay, going back on, here we go. So going back to November 1st, so we can see here we're looking at the dollar yen. That is the S&P 500 in the bottom left, and you've got gold in the top right. So this is about So the rate comes out. One thing to bear in mind is that unless there are glaring bits of text from the Federal Reserve that are definitely hawkish or definitely dovish, okay, then you kind of get this sort of reaction that you're seeing now, where the markets are kind of deciding, okay, what is there for me to bite down on? Is there enough for me to bite down on this or not? And in this case, the market reaction wasn't that big. If you guys have a look at the ranges and ranges and deviations Google Sheet, you can see it was bigger than the last one. Excuse me, hold on. It was smaller than the last rate decision back on the 20th of September. You had about 38 ticks towards the upside on the S&P. But the last time around in September, you had about 60 ticks towards the downside on the S&P. So if I just, you can see that usually with statements, if the rate comes in as expected, and there isn't anything new that's provided by the FOMC or anything that shocks the markets, you could get some a reaction more or less like this. So let's kind of skip ahead and see how far that market reaction had gone. So yeah, you can see choppy day with data and the FOMC, except on the 2-year on 2 bond, you'd seen more of a cleaner reaction compared to the other areas within the market. Okay, keep going forward. What else do we have? Okay. So then it becomes more or less the event happens, the rate's done, and the market kind of goes back to its going back to its movement that it had seen prior to the FOMC. Okay, all right. So let's escape from that there, and let's close that because we're done with that now. Okay, so the deviations and ranges now. If you have access to the deviations and ranges Google Sheet, what this does is it provides you with a history of how the economic releases have impacted the markets and by how much, depending on what the figure is. For interest rate decisions, there's a bit more it's a bit more refined, as you have a statement that is provided or the sentiment that is provided from the Federal Reserve. Then shows what the impact was on the markets. But for other releases, like non-farm payrolls, Canadian employment change, US CPI, and the US GDP data, okay, we have how the markets have reacted. Okay, so let me kind of show you how it works. So if we're looking at the FOMC today, at the last rate decision. So this initial figure here, hopefully you can see it on what I'm highlighting. So this initial figure here shows you the initial market reaction going to the wake of the candle. All right. And then this figure in the brackets here shows you the market reaction going to the end of the candle 10 minutes after the release has occurred. And then here in the blue brackets is the market reaction 30 minutes after the release has occurred. Again, going to the end of the candle. So it gives you more of a breakdown. What I used to have last time, where it would just be the initial market reaction and then 10 minutes. Now it's 30 minutes, because sometimes it can, of course, people have asked for that because, of course, it can. That momentum can continue to carry on for longer than or maybe expected. So as I said, it shows you how big the market reaction has been to economic releases, and then for interest rates in particular, only there do you get what the sentiment is, because it's not just the figure. There's also the statement that you have to kind of break down and understand. So in this last time around, what we had was, as mentioned, rates were left unchanged. And note that tighter financial and credit conditions are to weigh on the economy, and they repeat that it will assess the extent of additional firming, but there was nothing new, hence the whipsaw reaction from the markets. So there wasn't, as I said, there wasn't really anything new. It was just saying that tighter credit conditions are going to have an impact on the economy, but it wasn't enough because it was, other than that, everything else was as expected. There wasn't anything new. Okay, so that's the that's a little prep there then for the deviations. Now, if you would like access to the deviations sheet, and we've had people saying, how can I get my hands on it? Then all you got to do is sign up to the MACROACE main list, which is here. Yep, got people asking for already. Yeah, so Scott, this is how you can get your hands on the MACROACE Google deviations and ranges Google Sheet. All you got to do is subscribe to the MACROACE mailing list. Once you subscribe to that, you'll get an email on Monday is when I post out the week ahead for the economic releases to get access to what to expect for the week ahead and also the deviations and ranges Google Sheet all in one place. Okay, so I just wanted to also kind of temper some people's expectations from the past. Not only do you get the link to the ranges and deviations and the upcoming live streams that we have, if we do have any live streams, okay, we don't cover every single release. We cover the ones that are going to have the potential for the most volatility within the markets. You also get a short summary of what to expect in the week ahead for Europe, Asia, and the US sessions as well. The upcoming economic releases, a little bit of a breakdown of what could happen, but it's very short and concise. There's not always a lot of information there because it's supposed to act as more of a refresher rather than be bogged down with the load detail, because I'm going through all that detail with you guys here. And that's how I like to present the information. Like I said, if you liked the video so far and you've enjoyed it, great. That's great. Then give the video a like, subscribe to the channel, get the word out there. But yeah, so one of the things I wanted to also kind of mention, if we're looking at what has seen the biggest market moves, we can see last time around, generally, the dollar yen sees the biggest moves out of the currencies. And that's because of how the Bank Japan has been in the easing, hasn't come out of their negative rates settings for a very long time. So the dollar yen, or the yen, has been hit hard, or has seen a lot more volatility with its peers compared to other currencies and their peers. So here we can see last time around, though, it was a bit different. On cable, you had seen the biggest market reaction. But historically, it has always been the dollar yen that has seen the biggest market reaction out of the currency pairs. So last round, there was only 21.5 pip move towards the downside. But overall, statement was more or less from how we can see the market reaction. It wasn't that great. And when I say it's not that great, it didn't provide any real volatility enough for somebody to go whoopee and jump on the bandwagon and whichever way, going up or down. So yeah, as you can see here, the market reaction was kind of muted before 10 minutes were even up, or the first 10 minutes. You can see that the initial market reaction was for the S&P 500 going up by 38 ticks, and then after about 10 minutes of trading, it was 10 ticks down. So it's choppy, and it wasn't that volatile within the markets, because the statement wasn't that volatile either. But today we get the summary of economic projections. So as said, if they reprice their expectations for the federal funds target range, let's say if they do go back towards the June economic projections, that could provide a very potentially bullish reaction for the stock market and a bearish reaction for the dollar. If they revert back to that, or if they go even further with the summary of economic projections, if they're more or less in line what they had previously seen, going from 5.1 for the federal funds rate to let's say about 4.9, there's not that much of a difference, but that could be the more likely scenario because the Federal Reserve doesn't want to give the idea that they're going to start cutting rates soon, which will then provide Powell, when he goes into his press conference, to say that they're not thinking about rate cuts and when to do them. I.e., when I say that they're not thinking about how to do rate cuts or when to do them, but it gives him the scope of what the other FOMC members are thinking and what should be done. And then Powell can then nice and easily guide the market to, in the future, to when the central bank could start cutting rates, or given a potential, maybe not an exact date, but through his language and what he doesn't say or what he does say, that will then give the markets the stamp of saying, right, okay, this is the likely time that the Federal Reserve is going to cut rates or not. Getting a lot of questions about the Google Sheets. Yeah, so don't forget, if you subscribe to the MACROACE mail list, I'll pin it actually, because I think it's now gone in the chat. So if you subscribe to that, you get access to the main. You get access to the Google deviations and ranges sheet. Okay, and like I said, that's completely free. So that's all you got to do. Sign up to it, and you get an email Monday. Of course, there isn't going to be anything to cover next week, but that doesn't mean you can't sign up to it for January. Get ready for January's decisions. But yeah, so right, okay. So what else was I saying? So yeah, so I was just saying, if the Federal Reserve lowers their expectation of the federal funds target range back towards a June summary of economic projections, that could provide a very bullish market reaction for the stock market and a bearish reaction for the dollar. On the flip side, if Powell again reiterates that it's too early, that the Fed isn't thinking about rate cuts and it's too early to talk about it, then again he provides, and there's the expectation that rates are going to stay at around 5.1%. If it does, let's say if the rates expectation does for whatever reason go higher into 2024, which at this point wouldn't make sense considering how the economy has been trudging along, then that would provide a very bearish reaction for the stock market and a bullish reaction for the dollar. If the Federal Reserve or FOMC members are expecting a more tighter conditions going into next year, rather than looser financial conditions going into next year. Okay, let's see what else language-wise. Let's see what else we have here. So yeah, it's the language is it's going to be hard to kind of underpin the difference between what the Fed had said last time and what the Fed say the next time round. So sometimes you kind of have, so if as said about the talk of rate cuts, if they do say that they're not talking about rate cuts and it's too early, but they get rid of the and it's too early bit, that can be a big yeehaw for the markets, that the Federal Reserve is going to be discussing it soon, if that does happen, potentially. Steve Rock says, when Powell talks, you might just throw a grenade into a room. It's down 1 minute, up the next. I don't trade Fed speeches. It's kind of got to have nerves of steel, to be honest, and you've got to really understand and try and hear what the difference is between what Powell said before and what he's saying this time round. So yeah, it's not surprising, and it's nothing to be afraid of. If you decide that it's with the Fed or the Fed rate decision that it's not for you, that's fine. That's perfectly fine. Sometimes it is best to kind of sit it out and see what the Federal Reserve has actually said, and then make your decision as to what you want to do for after the aftermarket moves, if you do really get that, if you get that much, or just go on holiday. Just take a day off, go home. Maybe you're already at home. Okay, if you're at home, open up a Jack Daniels, relax, grab a cigar. Just grab a cigar. Just puff away. Forget the Fed. Just relax. But yeah, it's up to you what you want to do. That's like with anything, any economic releases, even non-farm payrolls, which is easier to understand because it's just one figure or a couple of figures here and there. You've just got to look at, and then you make your decision. Federal Reserve is much trickier. Yeah, go to Bangkok, smoke some, get some of the Bubba Kush. All right. So somebody's White Eagle FX says, what will happen if rates remain the same, sir? Then you're looking at what the statement says. Just got to see, is it more hawkish or dovish than what has been previously said, or what the markets are expecting? If it isn't either way, then you might just get more of a reaction like we'd seen last time around, where it's a bit more muted. And it's just you just get more whipsawing reaction that happens. Okay, so that's the ranges deviations, and of course here FinancialJuice on our newsfeed. As said, I'm the head financial analyst at FinancialJuice. Here we have our live voice and text service. Okay, you have your voice service here on the right hand side. You can see I've just clicked on it there. Should be able to see where I've clicked. Okay, that's where the live voice comes through. So we provide live voice and text service for global macro news of what's going on in the world, what's going on in the markets, why have the markets been impacted, if there has been any news or not been any news, are all in one place. So you have your voice feed there in your top right hand corner, and in the center you have your live text as well that we post out for you. As I said, all live in real time. Here you also get the market reactions if there have been any comments that have come through or economic releases that have moved the markets. And on the left hand side you have the economic calendar as well, giving you the preview for the week ahead, what to expect, and the economic release data. As I said, all live and in real time in one place. So again, live real-time news about global macro news and market moving news all in one place is what FinancialJuice aims to do. So if you are a day trader and you want to be able to capitalize on that bit of news, any bits of news that could occur, that could then shift sentiment within the markets. Okay, so if we have a look at the market moving stuff, kind of go back here, you can see here some news on the crypto space. Kind of go back a bit more, find some other headlines. Again, you had the Bank of Japan this week saying it sees Bank of Japan is said to see little need to end negative rates in December. That was back on December 11th. Here again, that's a bit of news that moved the market. Okay, and then here as well with Ueda, when he had his comment in front of the Diet, or Japan's version of Parliament. That had caused the yen to then see a large amount of strengthening over a period of time, is what you had seen there. But as said, so you get to see those, you get to see that there, and be at the forefront of the bleeding edge of news is what you get to do with FinancialJuice Pro. So there is a free version of this as well, but I'll provide you the link. The free version of FinancialJuice. 9 minutes. Okay, great. So the So the free version of FinancialJuice, as said earlier on, that there is of course a difference. The free version, there is a delay to the news. There is also advert banners that you have and adverts that get played that play during the session. But if it's your first time using a live voice and text service, sign up to the free version of FinancialJuice. Figure out, or find out if it's something that could work for you in the future in your day trading, okay, in your setup or in your tools. If it does work for you, then what you can do is there'll be a button on the top left-hand side where I'm kind of clicking. It'll be around there, which will say Go Pro. And Go Pro, when you click on Go Pro, you've got your different subscriptions. Select your subscription. Of course, make sure you've verified your email, verified your account from your email before you decide to purchase any subscriptions. Once you've done that, and then you've selected your subscription, then log out and log back in, and then you should be able to see this beautiful site that I see here with your live voice and text service. And if you're thinking about going pro straight away, also make sure you create an account first on FinancialJuice. Otherwise, if you don't, then that's going to cause issues with your account and your pro membership. So just make sure you create an account first, you verified your account, then select your subscription, and then log out and then log back in once everything's all fine and dandy with your subscription. Okay, so that's FinancialJuice there. So let's put this down. We've got about 8 minutes left. Put it down. Okay, let's get TICKSTRIKE up and running. So we've got the dollar yen, keeping an eye on there. The Dow as well with the S&P. We got gold. We've got the dollar. I said we've also said the dollar yen, bond prices, bond futures here for the 2-year and the 30-year, and Bitcoin too. Bitcoin last time around, if I just double check it again, how much it moved off of the FOMC rate decision. Usually doesn't move that much. Nah, it didn't last time around. It was only about an 8-tick move, so not too much. Unless it's a very dovish statement by the Federal Reserve, then of course you can see more of a bullish reaction. Okay, let's kind of move that there. So TICKSTRIKE, if you're not familiar with what TICKSTRIKE does, it allows you to listen into and see how strong order flow or how much order flow that there is within the markets. That's in Forex, crypto, stocks, futures, ETFs and ETNs, and your internals like the VIX or the ADD. Okay, that's where you get to see. So, or another way to put it, what TICKSTRIKE does, it shows you how strong the buying or selling momentum is visually and audibly as well. So I'm getting a lot of ticks in my ear at the moment. So there's a lot more activity that's occurring within markets. Now, let me explain some of these boxes here. Let's go with the S&P. Oops. Let's go with the S&P here. So this number, this plus symbol, represents the buying momentum, and then the negative symbol represents the selling momentum. Okay, level 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that occurs, then TICKSTRIKE will give you a visual and audio alert to that. And then on this slider thing here, okay, the higher you go, the less sensitive that it becomes. And 15 is the max level. So 15 is the least sensitive to market reactions. So only when there's a lot of buying or selling that occurs will then this ticker box give you a visual and audio alert, and you can choose whether to go audio or visual, or you can do both. Okay, and also you can change the color of what kind of suits you. So it's not restricted to just red and green. Do whatever works for you. But again, for day trading as another tool to add to your arsenal, that's what TickStrike is there for. So if it is to manage your trades or capitalize on potential trades that you see within markets, again, TickStrike is the tool to use. Now, if you don't want to, subscribe to TickStrike, if you don't want to buy it, then we have the free version on the website as well. Although there is a 7-day free trial in the link that I'll provide for you guys here. Okay. In that link, I said you get a 7-day free trial. You can go onto the FinancialJuice newsfeed. That's restricted though. You don't get to chop and change what you look at or change the sensitivity of the ticker for the S&P, Euro, Dollar, Oil, or Bitcoin here. Okay, it's set, and you can't do much about those settings. But if you want to kind of understand how TickStrike works and how it could work into your day trading, then have a little play with it. Have the free trial before the free trial. All right, and then see what works for you. We've got about 4 minutes or less than 4 minutes now till the rate decision. But yeah, as I said, so have a little play with it, the free version. See if it works for you or not. And as I said, then if you do want to have a trial of TickStrike of the full version, then that link is there in the in the chat for you to have a little look at. Okay, and then you can make your decision. Of course, only do that, of course, with all of these, with FinancialJuice or TickStrike, only, do if you feel comfortable already. Don't just chuck yourself in the deep end because you might drown, and, then that's not nice. So yeah, have a little play with it, see if it works for you or not, for both those both those products and services that we have. Okay. All right. 3 minutes left, so I'm going to close some of these windows here. Let's get everything else set up. Okay, like I said, don't forget to like the video, subscribe to the channel, and get the word out there. I am going to go a little bit quiet first for the first part of it. I'm just going to try and gauge what the Federal Reserve has said. Now, again, if the Federal Reserve decides to hike at this meeting, which no one is expecting them to do, again, remember what I said about what the expectations are for the Fed or central bank, and if they deviate from what the expectations are, you get more volatility that gets chucked in that gets brought into the market. So if they do decide to raise rates at this meeting, okay. If they do decide to do a 25 to 5.75% from 5.5, then you could see a lot of strengthening from the dollar, but it depends. We have seen it where the central bank may have raised rates more than expected, but then the statement is not that hawkish or not that supportive, not that hawkish enough to then kind of sustain that initial pop for the currency, and it could reverse quite quickly. Like I said, rate decisions are fun, so be prepared. All right, 1 minute to go now. Yeah, thank you guys for joining us, for joining me so far. Like I said, I hope you found this information useful. All right, here we go. Can you show you my new settings, please? Yeah, I could have a little look at that, but we'll do it later now. Get that sorted. Don't forget tomorrow in the morning, tomorrow in the morning for Eastern time, we have the Bank of England, and we also have the ECB rate decision, and then that'll be it for central bankers that I'll be covering for MACROACE. Of course, the following week have the Bank of Japan, and whether they decide to jump out of their negative rate settings. All right, 10 seconds. I'm going to go quiet. Okay, so rates remain unchanged. Let's go through what the expectations are. So that's a position currently have at the moment here, there on the NQ, and bing, done. Okay, so the reason why I did that, you had, so the Fed funds rate view for 2025 was at 3.6% compared to 3.9%. Median Fed funds rate for in 2024 at 4.6% versus currently 5.4%. Okay, so they did revert back to June with their expectation. 2025 it's already been 2025 at 3.6% compared to 3.9%. Yeah, so I think it's just the main point being here, median view Fed funds rate at the end of 2024 at 4.6 versus current 5.4% policy rate. Okay, so remember, I think the last time around they said 5.1 in 2024. Back to the June projection. It's always nice when that works for you. Doesn't mean I'm always gonna, that's always gonna happen. So, okay. So let's keep an eye on TICKSTRIKE. See how far we go. Can we push it a bit more? Okay. All right. Let's see. Think. Okay. All right. I think. Okay. Cool. Okay. So did risk it with another small position around here, and then kind of jumped out. What you won't be able to see, will you? So, yeah, around here, I did like another little position, and then I jumped out at around there, just a tiny little one, but yeah, that's me done now. So I'm not doing anything anymore. That's me out of it. But yeah, so that was good. Okay, so let's see what else the Federal Reserve had said. Other than keep their rates unchanged. Let's get the summary of economic projections as well. See what they've done this time around. Yeah. Okay, let's bring this out. Here we go. This is the new one now. So for the summary of economic projections. So they've gone back to 4.6 compared to what they've seen in their June projection. What else? 2026 is more or less the same. Here we are. If you guys want to see that. They do see stronger GDP though. For the end of this year, slightly weaker in 2024, but not that much. 2025, more or less with the previous one, and same with 2026, but just 0.1% higher. So yeah, not much of a change in these areas here, but the big change being in the federal funds target range for 2024 and 2025. So they flipped it. Heh. Now, I'm not saying I'm the Fed whisperer. No, I'm not. Yeah, anyways, so that's the rate decision there. Like I said, if you like the video, don't forget to subscribe to the channel, get the word out there. And yeah, like I said, tomorrow we have the ECB rate decision and the Bank of England. Okay, so it'll be quite interesting to see how far they go with their statements too. Let me grab this up here. Let me grab the link for you. Okay, so that's going to be one stream tomorrow with the Bank of England and the ECB rate decision, because one's at 7 a.m. Eastern time, the other one's at 8:15. So I'm just gonna keep the first video running, and then you guys can join and sit down and relax and smoke a cigar. Okay. Yeah. So tomorrow, so you can join me at 6:30 a.m. Eastern time for the whoops, that should be a different time. 6:30 a.m. Eastern time for the video, for the live stream for the Bank of England, and then yeah, should because of the rates at 7 a.m. Eastern time. Okay, 6:30 a.m. Eastern time, about 30-minute prep. All right, ladies and gentlemen, thank you very much for joining me live. I hope you did find the information useful. Enjoy the rest of your trading session. Powell probably might just try and keep the expectations for rate cuts down. If he does say that if he does say we're not thinking about rate cuts, and removes his language of saying it's too early, again, that could provide another bullish move for the stock market if there were to occur. But it's kind of wait and see. You don't know what he's going to say. He might just stick to his guns and repeat what the statement has said, and look at the dot plot, or he might go on a bit of a tangent and say stuff that is unexpected. You don't know what's going to happen then, and that's very, very hard to predict. Enough as this statement is very hard to predict, very hard to see what could be mentioned or not mentioned. Wow. Right. Thank you very much. Have a good evening and good afternoon. Of course, it's the evening here for me in the UK. And I shall see you guys tomorrow in the morning. All right. Afuera.